Hey everyone, and welcome back. Today, of course, we are doing our stock market Q&A video for the month of July 2020. I'm actually kind of impressed that I've been able to do this on a month-by-month basis up until this point. So let's not jinx it. Let's hope that we can continue to do this every single month going forward. And for those who don't know how you can get your question answered on these videos, then the first thing that you need to do is be subscribed. And the reason why you need to be subscribed is that every single month I make a post on my YouTube community board, and that post will be seen in your subscription box, your subscription feed. So if you're subscribed, you won't miss that post, and you can just leave your question below that post as a comment, and I usually go through and select a couple of the sort of first questions that people are asking, whoever gets in first, sort of first in, best dressed. So ask your question there, and then hopefully your question will be in next month's video. But with that said, let's get straight into the video. The first question that we've got here is from Caleb, and Caleb asks, what objective resources do you recommend using to research a company's fundamentals, leadership team, vision, products, and growth prospects? Or is it a gradual process of hunting through mountains of information available on the internet to make a clear image of a company yourself? Yeah, I mean, there's a couple of major things that I always look at that gives me a very good foundational understanding of a business. First of all, using a website like quickfs.net to get your 10 years of financial data for the income statement, balance sheet, and the cash flow statement. QuickFS is fantastic because it gives you 10 years of data. Most websites give you maybe 3 years of data for free, and then you have to pay for any more. So QuickFS is great for that, for filling up the spreadsheet. In terms of learning more about the business itself and the management team and what products and stuff that they sell, most of that information that I get at first is coming from the management team. So it's coming from the company's investor relations page. And on the investor relations page, there's a couple of major documents that you will want to check out. The first being, of course, the annual report. And I do have a video on my channel going through some of the major parts of an annual report that I recommend you spend most of your time focusing on. So go check that video out if you're interested. I'll leave it linked down in the description below. But basically in the first section of every annual report, at least for US companies, they give quite a detailed explanation of what the company is and how they make money, what products and services they sell, where they source them from, how they do their marketing, and what are their competitors, and all of that stuff. And then another good document that you should be checking out is the proxy form. This is, again, a SEC filing. It's for US companies. And the proxy form basically gives you all of the information you need to know about the management team. What are they being compensated? Who are the major shareholders? And what are the different types of compensation that they earn? And how much of that did they earn? Did they earn their entire compensation, or did they only earn a little bit because they didn't meet some of their goals and that sort of thing? Oh, and for Australian companies, there is no proxy form, but the information about the management team is in the annual report. So for Australian companies, most of the information will be in the annual report, as well as the investor presentations. That's another good place to look. But for US companies, it's broken down into a couple of different SEC filings, the major one being the 10K, the annual report, and then the proxy form. And the second part of your question where you say, or is it just a gradual process of going through mountains of information? That's also true. It's not as if there's a place where you can get all of the information you need, just read through it, and then bam, you know enough about a company that you no longer need to continue to learn about it. When you're learning about a company that you want to analyze, that you want to invest in over the long term, it's going to be a constant process over 1, 2, 3 years. And if it's a company you hold for a long time, it will be many years. A process of just learning little bits and bobs here and there, learning about the cycles that the business goes through, changes that happen in the business, whether they have a product cycle that they go through every couple of years or every year, or something that they do every 5 years, and just learning little bits and pieces that are not sort of the foundation of how the business runs, but add to the clarity and your understanding of the business overall. The next question that we've got here is how to compare investment return on investments in between companies in the same industry with regards to opportunity cost. Yeah, so the way that I go about comparing investments, the first thing is that I don't just compare investments that I understand with businesses that I don't, because of course, if I don't understand the business, then I'm not going to be able to estimate the future cash flows of the business that I don't understand, and therefore I'm not going to actually be able to compare them at all. But when it comes to businesses in the same industry, if you understand how one business in that industry operates, then it's likely you will be able to learn about the other major businesses in that industry as well. And the way I go about it is really just focusing on expected return. So estimating the future cash flows for those businesses, and then using an expected return formula in order to figure out what is the return based on our estimations of future cash flows. And again, I have a video dedicated to expected return, which I will leave linked down in the description below if you want to learn more about how I go through that process. But essentially, that is one way that you're able to compare a couple of potential options. If both companies in the industry are really great businesses, they meet all of our requirements, and you are not sure which one to invest in, then it might be a good idea to look at expected return and see which one is offering you a better return. But ultimately, at the end of the day, if I'm going to invest in either of those businesses, there is a minimum benchmark of return that I need to hit. It's not as if it's just that one has a higher expected return than the other, so therefore I'm going to invest in the higher one. If I'm going to invest in it, it's going to need to at least generate me a 15% return plus a margin of safety for errors, which ultimately means I'm targeting something closer to 20 or 22%. The next question that we've got here is, are you expecting the market to crash or drop in the upcoming months, since we've had non-stop growth in times of uncertainty, as well as massively overvalued companies? If so, how are you approaching this? Yeah, so first of all, I would recommend, I'm doing a lot of recommending to watch other videos in this one, but I recommend you watch the recent Ray Dalio video that I just put out. I'll leave it again linked down in the description below. But I basically talked about this gap, this divergence between the price of businesses and the actual value of those underlying businesses. And a key driver of that recently has been the Federal Reserve, at least for US businesses, has been the Federal Reserve printing money and buying financial assets. And that's created a divergence. And basically from that divergence, one of two things can happen, or more likely a combination of both. Either asset prices or stock prices fall in order to get back in line with the valuations, or there is inflation that picks up from the printing of money, and that drives up business value to reach the prices where those businesses are right now. So it's not necessarily a case that there has to be a massive drop in the stock price in the stock market just because there's a divergence. It's possible that inflation is what drives the closing of that gap. And I won't sort of go in depth into explaining how all that works in this video, but again, check that video out if you're interested to learn more about that. And it's a good sort of thing to think about, why it's a good idea to not just be completely out of the market, thinking that just because businesses are overvalued that you should have no money in the market, because the market could very well stay overvalued for a very long time. And it's not necessarily the case that the market is no longer overvalued because prices fall. It could be the case that the cash that you're holding is devalued, which causes that gap to close. The next question that we've got here is, hi, great channel, Hamish. In the June Q&A, you touched on possibly selling down a stock and a position for cash should it rise 5 or 6 times. What percentage of holding would you sell, and why 5 or 6 times? Yeah, so 5 or 6 times was not, it's not as if when it goes 5x, I start selling. That was just kind of an estimation, I guess. But the reason why I would start selling a business is if it became really, really overvalued. So in other words, the expected return of that business was really low. So if it was below 5%, if I think that even if the business grows at a pretty generous rate over the next 10 years, because it's priced so high, if I think that its return is going to be quite low, then I would start to sell out of that business. And there's no real strict process, I guess, that I have, in the same way that when I'm buying, I'm just sort of buying a little bit at a time over a period into that business. I'm not sort of dumping money in one investment at one time when I'm making a purchase. At the same time, if I'm going to be selling something, I'm not just going to pull completely out of it. I will probably sell bits and pieces of it over time. But with that said, my general philosophy is that I want to lean on the side of buying and holding great companies. So I'm very, very hesitant to sell a business, even if it has gone up a lot. Really, it's only going to come about if I don't have any cash around. So it's a good way to free up some cash in the event that the market is overvalued, or there is some other better opportunity where there is a better investment. And as a result, I may move some money out. But there's no sort of strict guideline I have for how much, I guess, what percent of a position that I would be selling at a time. The next question that we've got here is, hi Hamish, can you inspire us a bit with your journey? How did you learn everything you know, and how long did it take you? Thanks for sharing. Yeah, so I started investing in 2017, so 3 and a bit years now. And really that was spurred on from, I started looking into the stock market as far back as what year would that have been? 2015. I started sort of looking into the stock market. That was when I was in year 10. I didn't do anything at that point. I didn't make any investments, but that was kind of when I first learned about it, and I thought it was kind of interesting. I'd always been interested in business. In 2017, I also went to university to study finance, so that obviously drove me wanting to learn more about it, and also helped with some really foundational understanding, I guess, in terms of accounting and basic corporate finance and that sort of thing, economics. So that was kind of where I started to learn sort of the basics, and found out that I was quite interested in learning about analyzing individual businesses. And then from there, I just bought a ton of investing books, and I was just sifting through a lot of books. So some of the major ones that I really enjoyed, of course, would be The Intelligent Investor, was one of the very first ones that I read. I read it, really didn't understand half of it, probably even less than that. I probably understood 20% of it at the time. I then went back and read it a couple more times after that to go back over some of the stuff I didn't understand. But that's a fantastic book. A lot of Phil Town stuff has influenced me substantially. His Rule 1 book, Payback Time, and his YouTube channel, of course. And then just reading and watching Warren Buffett interviews and reading his letters to the shareholders. I went through and read every single letter to the shareholders since 1964, and there is so much valuable information in there, just going through and reading those. And there's even a book where someone has put Warren Buffett's letters in order of category, so breaking it down into intrinsic value and management and the different sections that we talk about, competitive advantages. So going out and getting that book, I think it's called The Essays of Warren Buffett, that will help you to sift through all of Warren Buffett's letters to the shareholders in a little bit more of an ordered fashion. In terms of how long it took, I guess you could say that I started taking it very seriously around 2017, so that's 3 and a bit years. But to be fair, this has been quite an obsession for me, and I wouldn't expect the average person to spend as much time as I did learning about this stuff over that kind of a short period. I was going to university to study finance, and then my entire free time was spent also reading books and learning more about investing in general. So for the average there's no real average person. So for every single person, it's going to be different. I think that you can learn quite a lot quite quickly if you get into a good discipline of consistently learning more and trying things, and always having an open mind and questioning things that you don't understand. But how long it kind of takes is going to be different for everyone. And by how long it takes, I mean how long it takes for you to get really confident in your ability to make good decisions. And the last question that we have time for today comes from Brandon. Just a fun one here. You don't have to answer if you've got a bunch of other good ones. Do you see any benefit of people outside of Australia investing in Aussie stocks? If so, which one or sectors are the best? Yeah, so maybe I can answer this from the perspective of myself as someone who is Australian and invests mostly in the US market, and then you can apply the reverse in sort of my reasoning. But the reason why I don't look too much at Australian businesses is because generally I like really big brand name companies, and I'm looking for companies that have been around for a very, very long time. And if you look at the Australian market, most of the really big companies are in finance, financial institutions, banking basically, insurance businesses, or they're in resources, in mining, which is one of the biggest industries in Australia. So those industries don't interest me too much. I much more align myself with consumer-faced businesses that have big brands. So all of the brands that I use for my laptop or my phone or my camera, all of the products and services that I buy, they're American businesses. So in that way, I find it easier to analyze businesses that are in the United States, and I find it more interesting to analyze businesses that are in the United States, just because I have a little bit more of a closer relationship as a consumer to those products and services. So that could certainly mean that, that certainly doesn't mean that if you're outside of Australia, you should never invest in Australian companies. You may very well have an interest in a sector in Australia that is really, really successful. Resources being one of them. Australia is really big on their resources. So if that's an industry that you're really passionate about and that you have quite a bit of an understanding in, then Australia probably has some very good options for you there. So that is all we have time for today. And as I said at the start of the video, if you do enjoy these videos and you want to ask a question for next month's video, then what you need to do is hit the subscribe button. And then when I make that post, which will be in about a month's time, you will see it in your subscription feed, your subscription box. So go ahead and hit subscribe if you want to do that. And of course, hit subscribe if you want to see more content like this on a regular basis. And if you did enjoy it, the best way you can show me is by leaving a like on the video or leaving a comment, sharing your thoughts on today's questions, and maybe you have some answers that are different or the same or whatever it is. Share your questions and your discussions down in the comment section below. But other than that, hope you guys have a great day, and I'll see you in the next video.